Hello and welcome to another episode of Policy in Wonderland. I'm your host, Avi Amira. In Policy in Wonderland, just like Alice, we are going to explore and see the wonderful world of insurance, insurtech, and everything that's connecting to this amazing ecosystem. In Policy in Wonderland, you will meet startups from all over the world, key figures, brokers, and more. And before we jump in, remember to like, subscribe, and share this episode and the other episodes, of course. And don't forget to sign up for our newsletter on LinkedIn to stay updated on all things InsurTech and connect with others who share your passion for innovation in insurance. So, without further ado, we travel today to New York, and I want to invite my guest to join me as we go down the rabbit hole. Please welcome Ian White. Hey, Ian.
Hey, Abby, how are you?
I'm great. Great to see you again, and thank you for joining me today. Um,
Yeah,
we we first connected through Hodris for the founders group, and I was glad to meet you also recently at ITC Vegas 2024, of course. Thanks to Orna, by the way, from Orna Carney from FinTLB. Um, for me, in a way, you are the ultimate guest to dive down the InsurTech rabbit hole. Our previous conversation and the great content you share on LinkedIn made it clear that we needed to record this episode together. Um, so before we dive into MGA investments, telematics, captives, and more, I would love to hear more about your background and what are you working on today, but
yeah, sure.
your journey in
So,
insurance.
yeah, the journey. So, where did it start? I guess maybe I'll start with the 90s because people forget about the 90s. I worked in the 90s, did some business consulting. I went to business school and I started my first company in the wake of just economic malaise and difficulty after 9/11. And it was a mapping software company. It started off as a printed map, actually, but it quickly moved to a lot of collection of digital data related to neighborhood boundaries and then public transit data. At the time, Google Maps was like just nascent. I remember before the Slippy, the Ajax map came out, and I famously my first customer was Google, and I famously nobody knows, but I sold the map boundary data for neighborhoods to Brett Taylor, who was then PM of Maps at Google. It was like 2006 at the now think it was the Ware conference, which was an O'Reilly conference then, and then grew that company. Added in hosted mapping, so Tableau software OEM'd our mapping API. We served up custom data. So if you're a Tableau user, you want to visualize your data, you might want to look at it in the context of third-party demographic data. So we'd bring that to the table. All right, I sold that. But what that left me with was a keen understanding and appreciation for data itself, not systems to process data, but the underlying stuff. So we talk about data, you get into metadata, which I've been known to talk about for a very long time in one sitting. And so what I mean are the characteristics that are kind of under the hood of the boring stuff. So if you have, let's say, a point in space, so latitude, longitude, there are all these things you don't know about it that aren't represented in the space. Confidence, accuracy, lineage, provenance. Like, how do you understand that this thing is actually represented properly? Map data in particular is a funny one because a lot of people who don't really understand it say, I sent you all my geocodes or all my coordinates or all my addresses, and I'm looking at them on a map. And I say, yeah, you sent me 10,000 records and actually 5,000 are displayed on the map. That means 5,000 aren't representing properly because they're maybe geocoded improperly or the addresses aren't normalized or something else. So that's pretty crap data to begin with, but you may not even realize that because you don't look at the whole corpus. You're only seeing what is visually represented in a geographic sense. All right, so that's kind of stuck with me. I sold that to Pitney Bowes, which famously made postage meters, but had gotten into digital marketing by then. And then tried my hand in, I think it next was catastrophe reinsurance. So in California, where I was living, the earthquake take rate was quite low. It was down to make 2 or 3%. In the wake of the '89 quake, people kind of forgot about what it means. Pricing didn't really make a lot of sense. It wasn't required.
But wait. How you find yourself in insurance?
Yeah,
Not
I
by
had a friend.
accident.
So a friend at the time was working at an engineering. Right, good point. He was working at an engineering firm, and he was doing these large site surveys of commercial properties to help them basically put together a broker package. And it
Uh-huh.
just didn't make any sense to do the same costly work every time, but also meant that like residential property owners and smaller commercial couldn't get bids on this stuff. So just kind of to hurry up on it. The idea was to develop a small accelerometer to understand the soil type. We plug it in like a air freshener. So there's well understood geologic literature how to tease out the the waveform from the vibration to soil type, because soil type is pretty arbitrary. And the principal consideration for economic loss in quakes is soil type. Yet the input for, I think, California Earthquake Authority, wherever you're buying your insurance from, has to do with your zip code. So it's almost like, if you're in a given zip code, you'll have better quake risk, but soil type has nothing to do with administrative boundaries. Why would it? It doesn't make any sense. It's just like
Right.
a silly kind of convenience. It makes no sense. So if you can actually understand the soil type at a granular level, you can then better price the risk. That said, the USGS would periodically conduct studies to understand soil type, but it's not consistent. So there's lots of kind of gaps and holes in understanding of this. This is the first concept for me of using better data to better select or price risk. And I got caught up in reinsurance and how that works, and recognizing that other countries, principally Chile and Japan, are much more resilient how they think about response to quake, and the US is just not going to move very quickly, because if it ain't broke, don't fix it, although it's coming, the next one. So left that, did some consulting for a bit, worked for a company for about 6 months that was in the business of taking a lot of alternative data in the hedge fund space and representing it to investors, long, short hedge funds that would then trade on this stuff. So I was the guy doing deals with SDKs and app publishers to ingest a lot of location data and then help them develop these massively probabilistic models that work until they don't. And then it would give them an edge on a series of retail tickers. So you can look at, say, Best Buy, look at foot traffic month on month. Earnings are coming out. You can develop these models, which might give you a sense, and you sell that signal, or you deploy a trade. So it's kind of in the same general bucket as satellites on Best Buy parking lots, which actually never happened. It's stupid. It's expensive. It's anachronistic, but it like popularizes this world of alt data. So I left that industry because I didn't like it. It's kind of extractive, like I win, you lose. You're not adding anything to society. But insurance was a bit more interesting, because if you win, right, you generate something positive in terms of a lower loss ratio. If you lose, you're making a payout. You're to claim, right? And you're, in a sense, like making somebody whole, which at a moral level made me feel a lot better than the hedge fund world, which is important for me. People can do what they want. That's fine. Got into trucking because at the time, my then co-founder was in a family business and in brokerage. And so saw the perils of trucking every day in the insurance industry, saw a lot of inefficiencies, and this kind of wave of increased autonomy, call it self-driving if you want, although don't hold your breath. And obviously trucking being the Satan's pit of insurance seemed like an opportunity. It's incredibly anachronistic. The combined has been 112, 115 and growing for the last 10 or 15 years, and no real good solutions. Everybody's scared their pants off around the line. So that's when we started doing it around 2017.
Wow. Okay. Impressive. Let's in a bit talk about ITC. How was your experience at ITC?
It was different. When I'd gone in years past, I was kind of representing my company, Coffee, which we can talk about that, but I no longer have it. It's been sold. So I was going for different reasons. And a lot of people who want to talk to an insurance, they're not really there. Like vendor wise, sure, but paper capacity, a lot of those relationships that are in many cases not with me, but institutionally decades or hundreds of years old, they tend not to come out to a lot of the shiny stuff. So for Coffee, it was like, okay, it was kind of good to show off to the shiny investors, which we will talk about, but not so great for the old world stuff. Going back this time, I was largely just looking to understand for consulting, what can I do? Who's interesting? Who's doing what? A lot more focus, I think, every year on understanding data and software and how it can fit into everything from selection to underwriting and loss control. But you've got to have incumbents willing to step up and really develop these multi-year projects to make that work across the industry. Startups all day long can do it if you're risk bearing or not, but still, we're just like a tiny piece of the premium pie. So it takes time, but that's where a lot of the really exciting stuff happens. I think for the fourth year, I didn't get to go to any talks. I wanted to go to a few, but the meetings kept me busy. So, oh well.
Yeah, likewise. I think I like be all the 3 days on the expo, and of course the first one. So yeah, I'm waiting for the recordings. Let's start our talk from the basic. Recently, as we said, you've been sharing some great shorts with your hot bites, right?
Hot bites, yeah.
So before we dive into the topics we prepared, I would like to start with the basics. One of the most important things you mentioned, but haven't posted about it yet, I think, is about the art and science of underwriting. So as a former chief underwriter, I was kind of find it this fascinating because there's not a lot of people that talking about the art of science and science of underwriting.
Hmm.
And I see that how is essential it is to understand the fundamentals of insurance because we are keep running to tech or to the next business model and we are not just wait and think about what is the basic here.
Hmm.
What we are talking about? We are talking about insurance. Is the ACV is the right as the SaaS or for the policy or insurance in general, of course. What is your take on that?
I think to the art and the science piece, which I have another piece coming, I think this week.
Nice.
Well, depending on when this goes up, but on that topic, the, a lot of what insurance gets right is also what it gets wrong. So institutionally, there's so much in the brain of, let's just call them underwriters, the people who are evaluating and pricing the risk, like
Mhm.
at the desk. Um, the challenge is a lot of these tools come along and it almost wants to take the human out of the loop and automate everything. But you haven't yet extracted everything from the underwriter, and you can't really extract it. They need to be there. They need to serve an incredibly relevant and vibrant role in helping to evaluate it. So, I mean, kind of human in the loop is a perfect metaphor because why would you take them out unless there's something where the underwriter plays a marginal role or it's your underwriting strategy to simply just get as much premium as you can and worry about the rest later. Like any industry and any profession, if you have a lifetime of experience doing things one way and you're presented with new tools, it can be perceived as a threat. So look at like dock workers, right? Let's automate the ports. No, they're going to wreak havoc. We're just going to stand up as a union and say no, or they're actually not going to take as much care. We'll have higher losses, and that won't work because people don't use our port anymore because we're using robots to do this stuff. I think in insurance, there's a certain degree of within organizations trying to undergo transformations recognize that underwriters want to hold on to what they know because it's their job, it's their security, it's a way to express yourself. If you have a threat, of course you're going to respond in a way which is not going to be amenable. So it can kind of like throw people off a lot. I know it was maybe 5 or 10 years ago, AIG famously brought in like a boatload of data scientists to kind of rethink how they're underwriting in many lines. And so these data scientists were effectively on one side of the camp, and then you had on the other side actuaries. And who won? Well, the actuaries. They've been there longer. Like they know where the bodies are buried. They know how to behave. They understand the domain of it. A lot of data scientists don't, frankly, understand the domain as deeply as credentialed actuaries. But there's absolutely a role for both. But to kind of like throw the baby out with the bathwater is kind of goofy all around. But the nature of large organizational transformations are kind of just go all in and deal with the people stuff maybe later.
Let's step down on the actuary and the data science. Is there because the data science are more tech driven? Maybe.
They maybe I think that's their orientation. They also I think are generalists by definition. So an
Okay.
actuary by definition, you're trained in the using math and statistics for the purpose of something, as opposed to data science, you can apply it to anything. I mean, at Coffee, our actuary was phenomenal because he was credentialed, yet he spoke the language of software, right? And could work in Python, could use notebooks and speak the language that engineers want to be able to speak, and also communicate with underwriters, which is maybe more of his comfort zone, but nonetheless step out and use technologies that aren't traditionally used by actuaries. That's if I have like a quote, a problem with actuaries, it's that sometimes they are also, I'm generalizing, can be stuck in the mud on the tools and the approaches that they have and not want to recognize that you may not have to wait for 5 years of tabular data to be collected, because if we're looking at a machine driven behavior, it might operate within a lower variance consistently, which means, I don't know if it's 1 year versus 5 years, but you can also, depending on your organization, maybe take a little bit of a risk and say, I think it's going to behave the same way, so I don't need to wait as long. Whereas actuaries, I think many would simply want to wait until the end of time to make a decision, which is one reason you have, I think, a culture at certain underwriters of how they think about filing ratings and like when do they want to re-rate, R&D in the context of doing more work, which doesn't necessarily result in a filing. In a sense, it might be viewed as a wasted effort, whereas we at Coffee would view that as absolutely valuable, and we want to engage in this actuarial R&D because it's a way to set you ahead from your competitors in this boring old world in admitted markets of rates and forms.
No, I think it's the right moment to talk about coffee. What you
Sure.
did at coffee. What is coffee?
Coffee, what with a K, was
With a K,
trucking.
yeah.
Yeah, so it was a trucking MGA. Started in maybe 2017. We wrote from
But by the
2019.
way, this is the reason of for your background, or no?
Yeah. This truck is it's known as Big Red. It was Ford's first attempt at getting into Class 8 trucking in I think the early '60s. And this particular weird vehicle, which looks like a sedan being crushed by something else,
Yeah.
was I think it was like a pilot that they took around some trade shows in the '60s. Didn't Decided to abandon the long haul vehicle, the Class 8 truck. And then several vendors got control of it. And somebody still has the cab, I think, in their garage in North Carolina. And it just struck me as a bizarre looking truck. So I kept it. So it's a little
Nice.
homage to that. Yeah. But so coffee was a trucking MGA. Yeah. Started writing in 2019, finished writing in around December 2023. So close to 4 years of writing business. I guess the raison d'etre, if you will, was, it's a terrible line historically, very little adoption of technology. It's antiquated, relationship driven. Nobody wants to touch it with a 10-foot pole. Because the combined was averaging, depending where you look, 112, that means there's tremendous opportunity to be profitable, as opposed to, say, personal auto, which is a combined at the time of maybe high 90s. There's just not as much room there. You've got a ton of money in SG&A, a ton of competitors. Trucking is very, very fragmented. I think Progressive is the market share leader with maybe 12 or 15%, but also they're very narrowly focused on their appetite. And so the thinking was, well, can we use better data and technology to better, select, underwrite, price, and do things in loss control? And so how that manifested itself first was looking at the unique characteristics of every truck. So in something like personal lines auto, you look at the equipment, right? You look at the car, you know that if it's a Ferrari, you're going to rate it differently than a Corvette. They're both sports cars. In trucking, this doesn't happen. A Class 8 truck is a Class 8 truck. Further, we do have symbols. We do have an awareness of safety systems present in personal vehicles. So in PPV, we know if it has AEB, ESC, all these foundational building blocks of self-driving that are called ADAS, Advanced Driver Assistance Systems. And sometimes those are priced in by carriers. Sometimes this is where I go to some of the laziness, but there are other reasons for that as well. In trucking, none of this exists. So on 99% of the applications, you'll see an underwriter ask for maybe it's a truck under 20 years old, which is some kind of arbitrary distinction for, is it modern or not? But, 2004 versus 2024 is very different. So by looking at the VIN, the unique serial number, and decomposing all the features, everything from does it have a series of driver assist systems to is it a day cab, a sleeper cab, what's the axle configuration, who's the engine manufacturer, you can then, or whether we did, was develop a pretty compelling lift curve, that alone. So getting a 4X lift just off the equipment. So we introduced a third leg, the underwriting stool, which is the equipment. We're looking at the drivers like everybody. We're looking at the operations like everybody. Then what we decided to do was require telematics, which is also, I think nobody else did it. We required it and we paid for it. We started with Samsara, went to some other vendors over time. And the reason is that, as you could instinctively believe, it makes a difference. So for starters, when our agents would sell the product, they'd be told like, here's your quote and it's competitive for the segments that we like, but telematics is required. Some fleets would say, no, thanks. Right. So interesting selection falling out of that, where they don't want to be insured for a lower price because there's something nefarious going on. I don't know, but let that risk fall on somebody else's books. So it's a policy condition. It's required. So, it's grounds for non-renewal or midterm cancel. And out of that, we're able to get a whole lot of data, obviously, that helped us inform future underwriting, future, and loss control and future insurance product. So I love talking about the one of the ISO modifiers in trucking. It's called garaged zip code, right? Okay. So where is your truck parked? I can't remember what the weighting of this is, but if you have a truck and it's not moving, you're not generating any revenue. So the very premise of kind of having this mod is, I understand why there are a lot of other things baked into that zip code, but it's kind of goofy. So what we started looking at was what's the actual exposure along every freight lane. So if you're running Boston to Miami-Dade, that's the exposure you want to look at and understand and evaluate and incorporate into rates, not your garage zip code where you are hopefully 1% of the time. And so we began to pick off some of these factors over time. We had integrated first notice of loss, all the smart things you would imagine if you're starting from a fresh book, which we had the good fortune of doing. We had telematic safety reports. We could look at our different cohorts relative to the general population, see what people are doing. We could see well before renewal, are they going out of their service area? Why are they in California when they say they're running Boston Miami Dade? Is this a one-time thing or is this regular? We need to re-rate you, etc. We made it into several police reports. So Morgan & Morgan and all the great litigant firms can't really touch you if you make it into a police report, showing the officer, here's what happened, helps you establish facts. So it saved us, many, many times, and it's just a no-brainer. The problem is risk partners don't have to believe that right away. So we paid for it up front. Mm-hmm. So we paid an extra 5 to 8 points, depending on a variety of factors, which we would get back in terms of better loss ratio. But you don't see the results of that for several years because, like many in this line, we're on a sliding scale of profitability. So we don't get those extra profit sharing commission back to us for maybe 24, 36 months. So there's a big cost, not just in terms of cash flow, but in terms of the future of the business, thinking about telematics that way. We did admitted and not admitted markets, focused on owner operators up to maybe 50 trucks.
So do you really think telematics really moved the needle here?
Yeah, absolutely. And I think the key thing was not inserting it in as a point solution and saying, we do telematics, we're kind of done. I mean, I've seen for a lot of other underwriters, the applications will be check a box if you're using telematics. And so you check a box, you get a discount. Nobody's asking for any token, any API key, any evidence that you're using it, much less use the data to think about better underwriting, a risk assessment on any level. We did it. Again, it's to help with real-time driver coaching. It's to help with periodic reviews. It's used at renewal. It's used for FNOL. The FNOL piece alone is a no-brainer and is massively useful. But we went further and said, we want to have through our policy admin system, which was homegrown, not out of a desire to, but because there's so much, let's say, difficult software to use that's put out by established vendors in the line, at least that we were operating. And being able to have one choke point where all data flows through was essential for us. So we can take this data we're seeing from telematics, incorporate it in loss control, and effectively feed it back all the way in the front end to risk selection so that we can better define what business we want, and our underwriters know it, they see it, they know it when they see it. And so it needs to be this virtual loop. Just plugging in telematics doesn't really get you anywhere. It might win you, a high five with the boss. It might help you next quarter, but it doesn't go to any sustained benefit and differentiation over time.
And did you operate as an MGA?
We were operating as an MGA. Yeah, we're getting down the road of standing up a captive, but we never got there. I'll kind of maybe quickly advance to the end of coffee, or want to wait for that?
No, go ahead.
Yeah. So what kind of happened at the end of the, yeah. So we were writing, I think at our peak, I think we had 15 or 20 million in force. I think we wrote close to 30 million our last policy year. This was early 23. So the goalposts for venture funding were moving, which is another topic I know we'll get to today. But we had an inside investor who reneged on their financing round, who I'd love to throw under the bus, but it doesn't really matter because they're probably not in the business anymore. And we also had some indirect exposure to Vestu. So Vestu, for those of you who don't know, was an Israeli insurtech that was seeking to collateralize reinsurance through letters of credit. So, help with the placement, make it more efficient, faster. Good in theory, but in practice, fraud is not a great way to run the business. So, right. So $6 billion in fraud. One of our reinsurers that was on our treaty was exposed to Vestu, and our fronting carrier said no to this. So they were kind of kicked off. And so we were in this kind of Schrödinger's cat scenario for a while where we needed to find retention. We didn't have to find retention. This is where this captive was going to stand up and help us. But then again, this investor reneged. So we ended up effectively the treaty being canceled roughly at the end of 2023. Wow. And part of this was being able to raise additional funding, which we had tried to do earlier in the year, but the goalposts were moving. So the silly concept of ARR and where are you? And so get 5 million ARR, no 7, no 10. And as you know, anybody in insurance, you can close your eyes, you can write to $20 million ARR, if you want to call it that, overnight, but you're going to pay for it in spades. And we refused to do that. We only wanted the profitable business, which means grow responsibly. So we didn't get to this like goofy metric of ARR that was deemed by investors because frankly, they didn't know what they were doing. And look, hey, I was in that game. I was taking their money, but it just proves how silly the whole thing is because you end up in this InsurTech paradox that I love talking about. You either grow really quickly, and the consequence is your risk partners suffer and you ultimately suffer because we have loss ratios that will frankly shit the bed. It just hasn't happened in the history of insurance. I don't think it's going to happen in 2024 or 2025. Or what you do is you grow slowly at, say, I don't know, 30% per annum, which is fine. It's great in insurance. You satisfy your risk partners, but your venture investors that are looking for a return like immediately are going to say, this is not that great. We're going to mark this thing down, or we're going to write it off. We're going to ignore you. And that's the game they're playing in, but it's kind of like playing apples and oranges. So it's a paradox because you're kind of stuck in a box, and any way you move, it's not going to end well, which kind of goes further to, well, if you've got an idea for an insurtech or an MGA, how do you grow the thing incredibly quickly? And the answer, I like to think, is generally speaking, with a few exceptions, is you do not do that. That's not what this is. Like any investor who's, let's say, impatient, venture and some others, don't come here. Like, do not enter. You're not wanted. It's not going to be helpful. It requires patient capital. It requires disaggregated capital because an equity check doesn't do everything you want. You might want to set up a captive. You want to use equity capital to set up a captive. Is you really want a surplus note. You're probably going to want to access some of the escrowed commissions because it might be tied up for 24 to 36 months. It might be guaranteed, but it's still escrowed. And a venture investor they don't have those facilities. They don't understand them. If you're starting off, you're not going to be able to go to a bank and take advantage of that because you're just not dealing with enough money for them to pay attention. So there are a number of reasons why the traditional venture impatient investors in MGAs are probably not going to suit your needs. There are a couple exceptions. Maybe I think cyber was one in the first couple of years, which proved itself possibly willing to look at this stuff. I mean, you can look at Corvus and the outcome there, which was what was it? Was a 2x premium, I think they sold for. So maybe that was a win, but the expectation was it needs to be, it was like 7x revenue or something, which is entirely different because of this ARR metric and SaaS business, which is, again, not what insurance is. It's a risk-bearing business. Anybody in insurance can grow at unsurpassed speed in any industry, but it's not going to benefit you because there's a cost to your account. I'll pause after this. There's a way I like to illustrate this, and that is, if you're enterprise SaaS, what's the maximum cost of an account? Well, let's say your ACV, your annualized contract value, it's $100,000. I don't care what you do. It's like a Salesforce type thing. So your customer threatens to sue. Worst case, you give back $100,000. I mean, sure, they can sue you, but you give back the money. In insurance, what's the worst case that can happen on the $100,000 account? Well, let's say in the case of trucking, $100,000 annualized over a year might be, let's say, 10 trucks, and you might have $1 million limit on every crash. So you got $100,000, you're giving it back, versus trucking, you've got $100,000, and it might be, certainly millions of dollars. So you don't want to be writing this thing every day of the week. You want to be slow and prudent to make sure you get the profitable business. And that's a fundamental tenet of insurance and also lending that not a lot of folks understand.
So let's dig in it. What the traditional venture, or even, like the InsurTech ventures missing here? And because we remember that at the beginning of the InsurTech era, like 2016, 2015, most of them looked at InsurTech as a SaaS, as you already said. How they see right now the InsurTech and what they are still missing?
I think it's getting better. I mean, I think you have fewer investors willing to put money into some of these MGAs that have to grow very quickly. There are a couple of contrarian investors out there who think differently, and I can spar with them. I think that's fine. I think it's good. Somebody like Lemonade, who is like famously maybe the first to do this. So what is it? It's like 10 years on, like gone through like $1 billion plus of investor capital. They're not profitable. Their loss ratio is coming close to like, I don't know, like second or third quartile in industry. Like eventually they'll get somewhere, but is it a stock worth buying if you have to wait 15 years for it to start performing? Like, I don't know. I think it could be a great distribution channel because they have a lot of smarts with UI and app development and all that stuff. But again, are you a technology company? Are you an insurance company? Well, you damn well better stand up and say you're in insurance if that's what you're doing. Because if not, you're just not understanding and recognizing the real concern. I think that a lot of would-be entrepreneurs in this space are recognizing it's going to take a long time to get somewhere with this because of the nature of risk. And I think investors see that as well. Unfortunately, what that does is I think it comes back to the age-old question of like, how do you grow a fast insurtech? And I think the general answer is you don't. And so if you know that venture investors or the impatient investors aren't the right kind of capital, what do? Well, you start off and you do something that can be profitable pretty early on, which is just an agency. And so you start off as an agency and then you grow that over time. You develop a reputation, relationships, profitability, EBITDA, which means something in insurance. It means everything, really. And then over time, maybe you decide to take some underwriting risk and set up an MGA. And if you're a couple of years in as a agency and then you take underwriting risk, I promise you it's not going to take as long to find paper capacity and get the program up and running. And at that point, maybe you're generating like, maybe you're positive EBITDA, and I'm sure you will be. And then you will be able to attract more capital. If it's maybe 10 years on, then some growth equity or early stage private equity might even look at you if you can take a check of 20 to 30 million to start. That's a way to do it. But unfortunately, what that means is like you don't do this big quickly. But that's just the nature of insurance. It's just not meant to get big quickly. Now, big caveat, if you're not risk bearing in any way, then you're just a SaaS business, and that's fine. If you're just selling your software, I'm not talking about you in that regard. Your sales cycle will be slow, but that's no different than any other enterprise segment.
How can I realize if I am a data enabler or an MGA? Not by definition. If I'm open an MGA, of course, an MGA.
Yeah.
But how can I identify myself as a data enabler or an MGA or an insurance provider? Do you know what I mean?
I think it's pretty easy. I mean, are you taking any underwriting risk? So if you're a data enabler, you want to sell your product for as much as you can to every customer on earth, and your price will be not really differentiated across segments. Maybe across segments it'll be a little bit, but it'll be largely like the price, not evaluating it per customer, and you're done. You don't really, I mean, you want to see them succeed, but it doesn't really matter. It doesn't impact your P&L. If you're an MGA, your future escrow will be impacted by poor performance. Your obviously loss ratio impacts your overall performance, your ability to capture additional reinsurance at better terms. I think it's pretty straightforward. You can still call yourself an insurtech. There's this kind of silly debate that's happened for years around what is an insurtech, and I think it's, in my mind, pretty simple to define that.
The reason I asked that is that because you like draw the path from agency MGA and then whatever you want to do, and it's very like it's pretty obvious, I think, but not that obvious. And I think to be like the data enabler and after that in MGA is also could be a good fit or good journey in the insurtech world.
Yeah, there's also a segment of companies that are effectively data enablers or technology providers that file as rate servicing organizations. And so this is another really neat, and I'm convinced like emerging way where there's gonna be a lot of value. So if you offer some differentiated technology or product or service that can change the performance in terms of frequency and severity in a line of business, do you want to step into the flow of premium on that? And so there's a way to do that. You have to capture your own, the way that ISO is there every time you're writing business. And as the business grows, you grow as well. You're not, I think, taking underwriting risk. You could do other interesting arrangements probably around that through a captive or some other mechanism. But I think that's a great way to be vested in the outcome of the industry you're serving.
I want you to talk right now about captive insurance. And let's talk about captive and tap down about MGAs and eventually about fundraising, especially, of course, in insurance. Let's talk about captive and even about the E&S market, because this is something that we can understand that the tech solutions from many reasons could be very good fit for the captive or the E&S world. What is your takeaway about that?
Yeah. So I'm no expert in captives or E&S, but I'll just kind of quick overview. So, traditional admitted markets where you're buying your regular products, that's where a lot of the business has played for a long time. In the last couple of years, there's been incredible, effectively all coming up to pricing pressure based on things like, the change in the nature of climate, which changes what cat risk really means, inflation, labor shortages, increased severity and frequency in many different lines. So everything's kind of spilling over, which puts a lot of pressure on rates. Insurers need to refile, but state regulators have their discretion. So if too many state regulators for too long say no, or we're going to slow walk this variety of reasons, that means the insurers can choose to pull out of a market or a line, which they've done. And then what you can do is you can re-enter that as non-admitted or surplus, which is kind of a little bit of the Wild West, where you're not filing rates, you're not disclosing much. As an insured, you have to prove that you're trying to get coverage in the admitted markets where the consumer or the business owner is kind of protected and is a bit paternalistic. But after you prove that in many states, you can then go to this kind of, it's not a gray area. It's without a lot less protections and insolvency protections as well. But that's where a lot of markets are moving because it's a way to get business. You just have to charge more and you can put, I think, reasonable expectations on those policies. Something I really like, and I think we should see a lot more of, is, to your point, using a lot of the technology in surplus lines, because you don't have to go through the same arduous like filing process and rejections and appealing and going back and forth with regulators for a long time. So thinking about a given line of business where you can add some kind of instrumentation or technology or process that helps you better understand the risk. So let's say, if you want to stand up a non-admitted line in trucking, you could require that you have to have telematics. And if you don't have it active, it's grounds for midterm cancel. So that way you can ensure that you're capturing that data, which can be really helpful in loss control and hopefully other areas. You can also capture enough of this data over time. So if you choose to kind of re-enter admitted markets, you would have collected enough experience around this technology that maybe that allows you to file rates based on this technology alone, which is something that's incredibly valuable. So if you saw through this technology a reduction of severity of 50%, you can then go back and you can file this over time in an admitted market, saying we saw this technology and here's our claims experience with it. We didn't want to use it for everything. So then when you're learning and you're doing a bunch of cherry picking in the non-admitted, and then eventually when markets soften, because they always do, you can bring it back for maybe, it'll take you longer to get into market initially, but ultimately there's kind of, I think, a bit of an equilibrium that tends to be more in markets, certainly for certain lines.
Just a sec, something happened with your mic.
Yeah. Let me see.
Test it. Yeah.
Turned off. I don't know why. Let me. This thing. I don't know why.
Okay, should be back on.
Yeah.
Yes. Okay.
I think you will. Yeah.
Yeah. Testing.
Yeah. Testing. Yeah. Okay. Great. Yeah. How was it so far?
Good. I'm just kind of just blabbing,
I told you I just want to hear you and blab as much as you want.
Yeah.
I want right now. I want just to take advantage of this break to go back to investments and especially to understand the way that VCs or investors in general need to understand when they are going to speak tomorrow or whatever, or whenever with InsurTech or with someone that say that you want to be in the insurance field. Okay. And I think we need maybe to clear what is an MGA, maybe. I assume most of the audience are familiar with the MGA, but how an MGA is relevant to VCs, how the business model of an MGA relevant to a VC's model.
Okay.
Yeah?
Yeah, sort of, yeah.
Makes sense, yeah.
Yeah.
Okay. So Ian, I want to tap down about VCs, okay, and how they need to understand insurance. You can hear it? You can hear me?
Yeah, I can hear you. It just changed again. I don't know why it's doing this.
The back one. No, no. It's okay. I will eliminate it after in the editing. It's okay.
Okay.
Busy day right now, huh?
Yeah, no, this thing died. This other mic died. I guess I didn't charge it enough. I don't know. cheap China quality.
Tell me when you're ready, and we'll continue.
Okay, actually, maybe hold on. I can plug it in here. Let me do this. Now it should work. I think I can make this work. Hold on. Okay, now it's good. Now it has power, so it's back.
Awesome. Write it down. I didn't know about the Vestor thing. It was kind of surprising, and how it's impact all over the world. It's amazing.
Vestor, yeah.
Yeah. I interviewed the chief insurance officer, Rita, here in Israel for the Hebrew channel.
Yeah.
Also about this Vestor, what she could say about that, and some in a way they blame someone. They're very young. In the accounting, some young student. It seems like too fishy. I don't blame her, but for the founders, after that, I heard a couple of things that you say, okay, now I realize a couple of things. So,
yeah. I'm sure there were signals before that people chose to ignore because of we do this. But then in retrospect, they all are glaring examples of flags.
Okay, let's go back. It's 15. So, Ian, let's step down about, again, investors, okay, and the VCs and how they need to understand the insurtech, or, you know what, even the insurance world. Because, again, this is not a SaaS world. This is an MGA, captive, agencies, and a very slow and a very slow world, okay? What do they need to understand when they are talking with founders of insurtech, or maybe with founders that they want to develop in insurance?
I mean, I think the investors need to understand the business a lot more. The problem is if you're, as an entrepreneur, if you're presented with an opportunity to receive money from somebody, unless you have a lot of options, you're probably going to consider taking it. The problem is you don't know what their motivations are. If you want to tell them when you're negotiating with them, like, here's how our business really works, I'm quite confident that if they're an impatient investor and they have some other idea about the industry, you might make them very skeptical at the end of the day, because it's not going to track similar to all the other industries where they're active as an impatient investor. What I mean is it's going to be super normal growth, and it's going to pay dividends when you go public or if there's a successful trade sale, whereas insurance, it will just take longer. If it's a one LP, if it's a family office, if it's something a little bit different, I think you'll have a lot more maybe interest, but you run a risk in doing that. You asked earlier about what is an MGA, and so maybe that could be helpful. Why do we have investor interest, or used to be obsession with the MGA? So the MGA is not a new concept, and it stands for managing general agency. It's somewhat analogous to a fintech, where Mercury Bank is not a bank. Mercury Bank is a technology company, which is writing on another bank's charter. And there are a lot of considerations that happen there, in the way that Coffee or any other MGA is not an insurance company. It's an insurance agency that's been given authority from the license holder. In this case, it's the carrier that has the paper, the licenses to write business in individual states. That's granted to you with constraints, and there's a reinsurance treaty that gets associated with that, etc. That's and when the carrier gives you that ability, they delegate the authority to you to have the pen, as they love to say, to be able to bind policies or distribute policies, whatever it may be. That's part of the excitement, because you're in a sense acting like a big insurance company, but you're much more nimble than one. The reason MGAs came to light whenever they started, and this is the insurance history, I don't know offhand, is they had principally one of two things going for them that a large lumbering carrier didn't. They had expertise in distribution, meaning they know exactly how to get their products in the hands of the people that want them, or they have some sort of underwriting expertise. So you can imagine, 100 years ago, you had general purpose underwriters for, commercial properties, and then you started to have, factories develop. And so some factories would have large boilers because they're doing steam related stuff for generating electricity, or whatever the business was, and you'd have specialization. And so that specialization became a way for MGAs to really behave much more faster because the large lumbering carrier couldn't get all its ducks in a row that quickly. They'd rather kind of create effectively, it's not a subsidiary, but they'd rather create or have created for them a group of nimble individuals that can work together on the paper of that carrier to then kind of fulfill that mandate of binding profitable business. I think what maybe the impatient investor saw is similar to the Mercury example versus the MGA stuff, which is you're kind of like a bank, but you're not burdened with all that crap that banks have to deal with.
And then think is apple to apple.
Yeah, I think like the Mercury to MGA is sort of apple. It's it's fruit to fruit for certain. There's some nuances, but in general, you're writing on somebody else's balance sheet, and so there are considerations for that. And I think that's maybe a lot of what the impatient investors understood. They didn't really think it through that much more, like all the de-aggregating capital and still a lot of regulatory stuff that you're doing because, again, the carrier doesn't want to do it. They want you to do it. And compliance is real. All the regulatory stuff is a big burden, and there are ways to be efficient at it, but it's still a regulatory burden that not everybody has to deal with.
What is another thing that the impatient venture investor are not realizing in insurance?
What is
another thing that the impatient investor that is not realizing in insurance?
Another thing I'm realizing, I think, is the domain matters a lot. So you have, like, Lemonade is a great example. Look at the founding team and where did their insurance background come from? I don't think they had it. Now, I don't mean to say that, I'm not trying to be difficult. It's just, this is like a reality. I think it would be interesting if you look at the founding team, look at it across different industries, who comes to the domain with that experience and for how long versus those that don't, and how do they perform, and how they perform can be measured in any number of ways, not just by raising money. That's only one metric, which is ultimately a pretty poor one, because raising money is a proof that you can raise money. It doesn't prove anything else at all by any means. But I think the teams, the ones that I really respect to a greater degree, are the ones that have the insurance expertise and recognize that there's a lot of, again, the art and science and underwriting, a lot of the relationships mattering tremendously. They can trump contracts, like a lot of times, like, well, here was a renewal for 1/1 for reinsurance, but it didn't actually get signed until 6/1. We didn't know it was going to be 6/1, but you know what? We acted like it was signed on 1/1 because that's what happens in insurance. And that's the way it behaves. If you have some kind of, kid who doesn't understand the industry, they'll kind of maybe try to take advantage of that and blow things up, which creates a lot of problems. So that's a little bit of, I think, what happened with Vestu, where it's trying to replace relationships with programmatic interfaces, and the relationships matter a lot. And there's a place for both because the efficiency is sorely needed. But again, it's not going 100% in one direction. And I think, again, the insurance expertise is something that a lot of the startups in insurance, if they don't have it, they acquire it over time because you need it. It just seems silly to start off without it because, if you're an MGA, you are an insurance. Okay, you're not technically an insurance company, but you are behaving like an insurance company and you need to. Don't try to get some other valuation with a higher multiple because you're lying to yourself and your investors if you say that.
Yeah, we are like close to the end. One last question to wrap things up. Looking back at everything we have discussed, from the fundamentals of underwriting to the future of InsurTech, what would you say is the single most important takeaway for anyone entering or innovating in the insurance space today? Or investing.
Patience, and then also focus is closely tied to that. So insurance, in particular for insurance, it's patience. And then obviously focus comes with that. So don't, if it's taking a long time to achieve results, you just got to keep doing what you're doing. You can't diversify into other lines of business or other ways of growing because it's going to hurt you, because it means you're taking your focus off that core thing. And that's what you've been set up to do. It just takes time. And if your investors are on board with that, just keep doing that. Now, you'll outperform markets over time, but it just takes a while to do that. There's a lot of noise that happens in the last, 5 years. We've all seen it and we all want a piece of it. But what goes up comes down. And when it really goes sky high, it's ridiculous. I mean, it's just like a ridiculous aberration in how much venture money there has been still after COVID and raising, these multi-billion dollar funds, change the dynamics of everything. A lot of times these investors are not really incentivized to actually deploy the fund in a wise way because they're making the 2% management fee off $4-8 billion. You can get rich doing that. So you can kind of roll the dice almost on the deployment of capital. And if somebody offers it to you, you want to take it, but it's almost a point of saying, no, you don't want it because you know what mission you're on, you have to fulfill, and you just have to be patient.
With that, we will finish. Wow, patient, patient, patient.
Yeah.
I think there is no other good advice, except that, in insurance, you need patient. I cannot agree more.
It's hard.
Ian, yeah. Ian, thank you very much. I hope it will be just our first conversation with many conversations ahead. And thank you again. Thank you very much.
Yeah, my pleasure. Really happy to join. There's a lot of lessons here. For whatever reason, I become an impassioned insurance advocate, never having thought I would be. But yeah, look forward to seeing you around.
And continue with the great job with the hot bites on LinkedIn.
Another one coming soon.
Awesome. Thank you. Bye-bye.